There is a ghost in your portfolio. It's a silent partner you never agreed to, one that takes a slice of your profits every time you make a successful move. It doesn't show up on your monthly brokerage statement. It doesn't ring an alarm bell when it strikes. It simply waits, patiently, for you to do what you've been told is smart, to lock in your gains. And when you do, it takes its cut, silently and ruthlessly siphoning away the fuel for your financial future. This ghost is the ever-present, ever-compounding drag of taxes. Most investors, even seasoned ones, spend their entire lives fighting the wrong enemy. They obsess over market crashes, geopolitical risk, and interest rate hikes. They spend countless hours trying to find the next 10-bagger stock, the perfect entry point, the flawless exit. But they ignore the single greatest destroyer of long-term wealth, the one variable they actually have significant control over. Warren Buffett, the man who built a $250 billion empire from a dying textile mill, understood this from the very beginning. He knew that the secret to supercharged portfolio growth, to truly monumental wealth, wasn't just about picking great companies. It was about defeating this ghost. It was about structuring every single investment decision to minimize its corrosive touch. What you are about to learn is not a clever trick or a shady loophole. It is a fundamental shift in perspective. It's the difference between thinking like a gambler at a casino, cashing in chips after every lucky hand, and thinking like the owner of the casino itself, letting the odds and the structure of the game work relentlessly in your favor over time. The principle is deceptively simple. The most powerful way to minimize taxes is to hold on to your winning stocks for a very, very long time. This isn't just about patience. It's a calculated mathematical weapon. The costly market mistake it prevents is the constant churn, the endless cycle of buying and selling, of harvesting gains, which triggers a massive annual tax bill that acts as an invisible anchor, a relentless drag on your ability to compound wealth. The financial transformation you will experience by the end of this journey is profound. You will learn to think in terms of after-tax returns, the only returns that actually matter. You will adopt a low-turnover strategy that allows your investments to grow in a tax-sheltered cocoon, unleashing the full, untamed power of compounding and dramatically, almost unimaginably, increasing your final net worth. This is Warren Buffett's final promise, not written in an annual report, but coded into the very DNA of his half-century of success. It's the secret that separates the merely successful retail investor from the architects of true, lasting financial freedom. Our journey begins by shining a harsh light on this invisible enemy. We must first understand the destructive power of what we'll call the tax drag, this unseen anchor that weighs down the vast majority of investment portfolios. To truly grasp its force, we can't just talk in percentages. We have to see it in action, in the lives of investors. Imagine two friends, Sarah and Tom, who begin their investment journeys on the exact same day. It's January 1st, 2004. They both have a keen interest in personal finance and have each managed to save up a respectable $10,000. They're both smart, they read the same books, and they even decide to invest in the same high-growth stock, a promising tech company that they believe has a bright future. For the sake of our story, let's say this stock is a grand slam. It returns an incredible and consistent 20% per year. Sarah is a disciplined, active trader. She follows the market closely. At the end of that first year, her $10,000 has grown to $12,000. Pleased with her $2,000 gain, she decides to lock it in. She sells the stock, realizing the profit. She sees this as a prudent move in her wealth management strategy. After selling, she is hit with a capital gains tax bill. Assuming a combined federal and state long-term capital gains rate of, say, 20%, she owes $400 on her $2,000 gain. She pays the tax, and her net capital is now $11,600. Believing in the company's long-term prospects, she immediately reinvests the full amount back into the very same stock. She repeats this process every single year. She makes 20%, sells, pays her taxes on the gain, and reinvests the remainder. She feels smart. She is booking profits, meeting her tax obligations, and staying active in her portfolio. Now let's look at Tom. Tom has a different philosophy. one he picked up from reading about an old investor from Omaha. He buys his $10,000 worth of the same stock on the same day. At the end of the first year, his account also shows a balance of $12,000. He sees the $2,000 gain. But he does nothing. He doesn't sell. He simply holds. At the end of year 2, Sarah's $11,600 grows by 20% to $13,920. She has a gain of $2,320. She sells, pays her 20% tax of $464, and is left with $13,456 to reinvest. Tom's $12,000, meanwhile, also grows by 20%. It becomes $14,400. He still does nothing. The gap between them is already starting to widen. Let's fast forward. For 10 years, they both stick to their strategies. Sarah diligently trades, pays her taxes annually, and feels in control. Tom sits on his hands, watching his paper gains grow larger and larger. After 10 years, Sarah's portfolio, despite the fantastic 20% annual return of the underlying stock, has grown to approximately $48,000. A very respectable performance, but Tom's portfolio, by simply avoiding the annual tax drag, has swelled to over $61,900. By doing nothing, Tom is nearly $14,000 richer. Now, let's extend this to a full investment lifetime, say 30 years. After 30 years of diligent trading and tax paying, Sarah's initial $10,000 has grown to a fantastic $138,000. She is a millionaire. She feels her strategy has been a massive success, a testament to her active money management. But what about Tom? Tom's initial $10,000, left untouched to compound without the friction of annual taxes, has grown to an astronomical $2,373,000. At the very end, Tom decides to retire and sells his entire position. He now has to pay taxes on his massive accumulated gain. His gain is $2,363,000. At a 20% rate, his tax bill is a whopping $472,600. After paying this one-time tax, his final take-home net worth from this investment is just over $1.9 million. He is nearly $800,000 wealthier than Sarah, for no other reason than his strategy for handling taxes. He picked the same stock. He had the same starting capital. The only difference was his understanding of the invisible anchor. This isn't just a hypothetical. This principle was baked into the very foundation of Buffett's financial empire. In the late 1950s, when he was running his early investment partnerships, he wasn't just a stock picker. He was an educator. He gathered his family, friends, and a few brave doctors in Omaha, and laid out his ground rules. One of the most important was his fee structure, which was brilliant in its alignment of interests. He would take no fixed fee. He would only get paid if he delivered returns above a certain threshold, typically 6% annually. But the truly revolutionary part was how he took his fee. He would receive 25% of the profits above that 6% hurdle. Crucially, he explained to his partners that he intended to run the partnership with an extremely low turnover. He told them he would not be trading in and out of stocks. His goal was to find wonderful businesses and hold them. Why? He knew that every sale would trigger a tax event not just for him but for his partners. He was designing his entire operation, from its legal structure to its investment philosophy, around the central principle of minimizing tax drag. He was telling his first investors, "We are in the business of long-term compounding, not short-term trading. The government will be our silent partner, but we will dictate the terms of when they get paid." He was playing a different game, and the tax code was one of the key pieces on his chessboard. The reason so many investors fall into Sarah's trap, the trap of constant activity, can be explained by a powerful psychological flaw known as the action bias. Our brains are hardwired for action. In our ancestral environment, doing something, running from a predator, hunting for food, was almost always better than doing nothing. This instinct carries over into the modern world of finance. When the market is volatile, Or when we see a stock we own skyrocket, the urge to do something is almost irresistible. Selling a winner to lock in a gain feels like a decisive, intelligent action. It provides a sense of control and a small dopamine hit of realized success. Doing nothing, in contrast, feels passive, negligent, almost lazy. The financial media machine is built entirely around fueling this action bias. Every day you are bombarded with urgent news, buy and sell recommendations, and talking heads shouting about the next big move. Their business model depends on you acting, because activity generates commissions for brokers and clicks for media outlets. Inactivity is their worst enemy. Compounding this is another cognitive flaw, the salience bias. We are naturally drawn to what is vivid and easily noticeable. A stock price jumping 20% in a year is highly salient. You see it in green on your screen. The $2,000 gain is a tangible, exciting number. The $400 tax bill that comes months later, however, is far less salient. It's a line item on a complex form, a number mixed in with your income tax. It doesn't feel as real or immediate as the profit itself. The slow, methodical drain of wealth from your portfolio year after year lacks the drama of a market crash, so most people completely fail to appreciate its devastating long-term impact. They see the gain, but they are blind to the anchor it comes attached to. So how do we translate this understanding into a concrete, usable tool? We need an applied mental model, a blueprint for making decisions. Let's call it the 30-year tax-adjusted calculator. This isn't a piece of software. It's a thought experiment you must run before every single sell decision. Here is the step-by-step process. Step 1. Before you click the sell button on a winning stock, open a simple spreadsheet or even just a piece of paper. At the top, write down the total value of the position and the capital gain you are about to realize. Let's say you're about to sell a stock worth $50,000 for a $30,000 gain. Step 2. Calculate the immediate tax cost. Apply your estimated capital gains tax rate to that gain. Using our 20% figure, that's a $6,000 tax bill. You are not selling a $50,000 asset. You are executing a transaction that will leave you with $44,000 in capital to reinvest. You must internalize that the pre-tax number is a fantasy. The after-tax number is your new reality. Step 3. Project the two paths. Path A is your current plan. Sell, pay the tax, and reinvest the $44,000. Path B is the Buffett path. Do nothing and let the full $50,000 continue to grow. Now, project these two amounts forward over your remaining investment horizon, 10, 20, or 30 years, using a conservative expected growth rate, say 8% per year. After 20 years, the $44,000 from Path A would grow to about $205,000. The $50,000 from Path B, however, would grow to over $233,000. Step 4. Compare the futures. By simply clicking that sell button today, you are making a decision that could cost your future self nearly $30,000. Is the reason you're selling today worth $30,000? Is the new stock you want to buy so demonstrably better than your current holding that it can overcome this massive initial handicap? Running this simple, sobering calculation forces you to confront the true, long-term cost of your actions. It transforms the act of selling from an easy, impulsive click into a weighty, consequential decision. It forces you to justify not just the sale, but the enormous opportunity cost inflicted by the tax drag. To fully appreciate the wisdom of this approach, we must spend some time exploring its opposite, the path of the 99%, what we can call the day trader's fallacy. This is the world inhabited by millions of retail investors, fueled by zero-commission trading apps and social media hype. Their mindset is built on the idea that wealth is created through a series of clever short-term trades. They chase momentum, buy into speculative stories, and aim to scalp quick profits of 10%, 20%, or 50%. When they succeed, they sell immediately, believing they have, quote, beaten the market, What they've actually done is volunteer to pay the maximum possible tax rate. Short-term capital gains on assets held for less than a year are taxed at your ordinary income tax rate, which can be significantly higher than the long-term rate. These traders are playing the game on the highest difficulty setting with the largest possible handicap. Consider the story, repeated thousands of times in recent years, of the investor who gets lucky on a meme stock. They put $5,000 into a highly speculative company, and through sheer luck, it rockets up to $50,000 in a matter of weeks. Elated, they sell, capturing a $45,000 profit. A few months later, they are hit with a tax bill. Since it was a short-term gain, it's taxed as income. If they are in the 32% federal tax bracket, that's a bill for $14,400 plus state taxes. Their win of $45,000 is suddenly just $30,600. Feeling like a genius, they then take this diminished capital and try to repeat their success. But lightning rarely strikes twice. Their next speculative bet goes to zero. They have not only lost their original stake and their winnings, but they are still on the hook for a massive tax bill from their prior success. This is the disastrous consequence of ignoring the tax code. It turns winning into a liability. The day trader's fallacy is the belief that you can outsmart the market through rapid activity, when in reality, every profitable trade digs a deeper hole, transferring more and more of your capital to your silent partner, the government, leaving you with less ammunition for the next battle. The direct financial connection here is profound and appears in the most fundamental documents of your financial life. On your brokerage statement, you see a line called cost basis. This is the number that the tax authorities use to determine your profit. When you adopt a long-term, low-turnover strategy, you are actively preserving a low-cost basis on your best-performing assets. A share of Apple stock bought in 2005 for a split-adjusted price of around $2 has a cost basis of $2. Today, that share is worth nearly $200. The difference, $198, is a massive, unrealized capital gain. A trader sees this and sees a potential profit to be locked in. A Buffett-style investor sees something far more valuable. $198 of capital that is working for them, compounding every single day, without having been diminished by taxes. Think of it like a business. If a successful entrepreneur owns a factory that cost $1 million to build and is now worth $10 million because it generates immense profits, would they sell the factory at the end of every year just to book the gain? Of course not. That would be insane. They would be hit with a massive tax bill and would have to use the diminished proceeds to try and build a new, equally profitable factory. The intelligent owner understands that the value is in the continued operation of the highly profitable asset. Your winning stocks are your personal profit factories. The tax drag is the cost of liquidating them. By refusing to sell, you are making an executive decision, just like a CEO, to let your most profitable divisions continue to run and compound capital on your behalf, tax-free. This shift in thinking, from stock trader to business owner, is the first and most crucial step toward building a portfolio that can truly stand the test of time and generate life-changing wealth. This leads us to a more advanced and far more powerful way of thinking about taxes. It's not just about minimizing a cost. It's about transforming that cost into a strategic asset. This is the concept of the billion-dollar float, the true genius behind Buffett's tax strategy. To understand it, we must journey back to 1967, a pivotal year for Berkshire Hathaway. At the time, Berkshire was still primarily a struggling textile company. Buffett was looking for a new engine for growth, and he found it in the unglamorous world of property and casualty insurance. He orchestrated the acquisition of two Omaha-based insurance companies, National Indemnity and National Fire and Marine Insurance, for $8.6 million. On the surface, he was buying an insurance business, but underneath he was acquiring a money-making machine of unparalleled power. The magic of the insurance business, as Buffett immediately understood, is something called float. Insurance companies collect premiums from their customers up front, but they don't pay out claims until much later. if at all. This pool of money, the premiums collected but not yet paid out, is the float. The insurance company gets to hold this money and invest it for its own benefit. In essence, the policyholders are giving the company an interest-free loan. Buffett realized that if he could run his insurance operations at a break-even point or a small profit, meaning the premiums collected were roughly equal to the eventual claims and operating expenses, then this float was essentially a massive, permanent, and cost-free pool of capital that he could invest in stocks and businesses. Now here is the critical leap of understanding. The deferred capital gains taxes in your personal stock portfolio function in exactly the same way as insurance float. It is your personal float. Let's revisit Tom from our earlier example. After 20 years, his portfolio is worth $1,080,000 on a cost basis of just $10,000. He has an unrealized capital gain of $1,070,000. The potential tax on this gain, at 20%, is $214,000. That $214,000 is money that he will one day owe to the government. But right now, today, it is still in his account. It is still invested in the stock, working for him, compounding alongside his own capital. He is, in effect, the beneficiary of a $214,000 interest-free loan from the U.S. Treasury. This is precisely what Buffett has done on a colossal scale. As of the end of 2022, Berkshire Hathaway had a deferred income tax liability of nearly $80 billion, largely related to the unrealized gains in its massive stock portfolio. That's $80 billion that technically belongs to the government, but which Buffett gets to invest for the benefit of Berkshire shareholders, cost-free, year after year. He has turned a liability into one of the largest, most powerful investment vehicles on the planet. This is the secret hiding in plain sight. Every dollar of unrealized gain in your portfolio contains a component, your future tax bill, that is working for you as a zero-interest loan. The frequent trader, by selling and paying taxes every year, voluntarily gives up this incredible advantage. They are, in effect, telling the government, "No thanks, you can have your money back now. I don't want this free loan anymore." The psychological principle that prevents most people from harnessing this power is called temporal discounting. It's the technical term for our brain's powerful preference for immediate rewards over future rewards. We would rather have one marshmallow today than two marshmallows tomorrow. This is why people struggle to save for retirement or stick to a diet. The immediate pleasure of spending or eating is far more compelling than the abstract, distant benefit of financial security or good health. When you sell a stock and realize a gain, you get a small, immediate psychological reward. You see the cash in your account. It feels real and satisfying. The tax bill, on the other hand, is a future pain. It's months away. Your brain naturally discounts its significance. Buffett's genius is his complete inversion of this human tendency. He possesses an almost superhuman capacity for delayed gratification. He is willing to forego the tiny dopamine hit of locking in a gain today because his mind is intensely focused on the monumental advantage that the tax float will provide him for decades to come. He is playing a long game, and he understands that the person who can delay gratification the longest, who can allow their capital and the government's capital to compound together for the longest period, will win by an insurmountable margin. He isn't just investing in stocks. He is arbitraging human psychology. He is exploiting the markets and other investors' obsession with the present moment. To harness this in your own life, you need a new mental model, the government as interest-free partner model. It's a powerful reframing of your portfolio. Step 1. Calculate your personal float. Go through your portfolio and list all of your holdings with unrealized capital gains. Sum up the total gain. For example, you might have $150,000 in gains spread across several stocks. Step 2. Apply your estimated long-term capital gains tax rate to this total gain. Let's stick with 20%. In this case, your personal float, your interest-free loan from the government, is $30,000. Step 3. Revisualize your portfolio. You don't have a single pool of capital. You have two. Your own after-tax capital, $120,000 of the gains, plus your original cost basis, and your partner's capital, the $30,000 float. Both pools of money are invested side by side in the same stocks, working for your benefit. Step 4. Treat this float with respect. Your new goal as a portfolio manager is not just to grow your capital, but to preserve and grow this float for as long as possible. Before you sell any asset, ask yourself, am I willing to terminate this incredibly advantageous partnership? Am I ready to pay back this generous interest-free loan? This mental model shifts your entire perspective. The unrealized tax liability is no longer a scary number to be feared. It's a strategic asset, a powerful engine of growth. You start to see selling not as a smart move to de-risk or take profits, but as an act of financial self-sabotage, dismantling the very machine that is supercharging your returns. Now let's examine the antithesis, a common strategy that even sophisticated financial advisors sometimes recommend, which can inadvertently lead to the destruction of this personal float. This is the tax harvester's dilemma. The strategy, known as tax loss harvesting, involves selling losing positions in your portfolio to realize a capital loss. This loss can then be used to offset capital gains from your winning positions, thereby reducing your tax bill for the year. On paper, it sounds perfectly logical. If you have a $5,000 gain in stock A and a $5,000 loss in stock B, you can sell both. The loss cancels out the gain and you pay no taxes. The problem arises when this becomes a primary portfolio strategy rather than an occasional tactic. The dilemma is that an obsession with minimizing this year's tax bill can lead to a portfolio that is constantly in flux. It encourages high turnover. To harvest losses, you have to sell. To offset gains, you have to sell. This constant activity often leads to what is known as portfolio churn. You might sell a wonderful company that is temporarily down in price just to book a loss, only to watch it rebound magnificently over the next several years. You might sell a winning company far too early just to pair the gain with a loss, thereby paying back your interest-free loan prematurely. While tax loss harvesting has a place, particularly in rebalancing or during major market dislocations, a strategy centered around it runs contrary to the Buffett ethos. It optimizes for the small, immediate goal of a lower tax bill this April, at the potential expense of the far larger, more important goal of maximizing your net worth in 20 years. It's a classic case of winning a small battle but losing the war. It breaks the cardinal rule: never unnecessarily interrupt the compounding of capital in your best ideas. The financial connection of the float concept is one of the most elegant in all of finance. For Berkshire Hathaway, this massive deferred tax liability sits on its balance sheet. It is a key component that contributes to the company's legendary financial strength. For you, the retail investor, the personal float directly impacts your portfolio's effective growth rate. Let's do the math. Imagine two investors, both achieving a 10% pre-tax return annually. Investor A, the trader, sells and pays a 20% tax on gains each year. Their effective after-tax return is only 8%. Investor B, the long-term holder, lets their gains ride. Their portfolio is composed of their own capital plus their personal float, which let's say represents 20% of the unrealized gain. The entire portfolio, including the float, grows at the full 10% pre-tax rate. That portion of their portfolio representing the government's money is compounding at 10%, not 8%. This creates a subtle but powerful tailwind. It's like having a small leveraged booster rocket attached to your portfolio, funded for free by the Treasury. Over decades, this small difference in the effective compounding rate results in a massive divergence in outcomes. It's the mathematical proof of why holding on is not a passive act, but an aggressive strategy for wealth creation. It's how you build a financial fortress that can not only withstand market storms, but is structurally designed for superior performance, accelerating your path to genuine financial freedom. The mechanism that allows for tax deferral and the creation of your personal float is, of course, a low-turnover investment strategy. This brings us to our third pillar, the profound and often misunderstood power of inactivity. In a world that glorifies action, speed, and decisiveness, the idea that your best move is often no move at all is deeply counterintuitive. Yet it is the operational core of Buffett's philosophy. The perfect illustration of this is the story of his investment in the Washington Post Company. In mid-1973, the stock market was in a terrible mood. The Nifty 50 growth stocks had crashed, and pessimism was rampant. The Washington Post, despite being a dominant newspaper with a near monopoly in its market, saw its stock get crushed, along with everything else. The entire company had a market valuation of around $80 million. Buffett, through his meticulous research, realized this was absurd. He knew the company's media properties alone were worth at least $400 million. It was, in his words, like buying a dollar bill for 20 cents. Over a period of several months, Berkshire Hathaway invested about $10.6 million to acquire a significant stake in the company. What happened next is the crucial part of the story. The stock did not immediately rocket upwards. The company faced challenges, including a violent and costly pressman's strike in 1975. The market went through booms and busts, recessions and recoveries. There were countless moments over the next 3 decades when a prudent investor might have been tempted to sell. In the dot-com boom of the late 90s, media stocks were considered old-fashioned, and an active manager might have sold the Post to buy a hot tech stock. During the 2008 financial crisis, as advertising revenues plummeted, a fearful manager would have certainly hit the sell button. Buffett did nothing. He held. That original $10.6 million investment, through dividends and appreciation, eventually grew to be worth over $1 billion. His single greatest decision regarding the Washington Post, after the initial purchase, was the decision he made thousands of times over 30 years, the decision to do absolutely nothing. Inactivity was his most profitable activity. The psychological forces that make this masterful inactivity so difficult are powerful and deeply ingrained. The first is loss aversion, the well-documented finding by psychologists Daniel Kahneman and Amos Tversky that the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. This is why market downturns are so terrifying. Watching your portfolio value drop by 20% feels viscerally painful. The brain screams at you to act, to sell, to make the pain stop. A strategy of doing nothing during a crash requires an almost unnatural level of emotional fortitude. By having a low turnover strategy as your default, you build a psychological defense against this panic. You are pre-committed to inaction, which acts as a circuit breaker for your fear response. The second principle is the endowment effect. We tend to value things more highly, simply because we own them. A trader who views stocks as temporary holdings, as flickering quotes on a screen, has no endowment effect. They can buy and sell without a second thought. Buffett, however, harnesses this bias. He repeatedly states, "We see ourselves as part owners of businesses." When you genuinely feel you own a small piece of Coca-Cola or American Express, you become a reluctant seller. You feel an attachment, a sense of partnership. The idea of selling your piece of this wonderful business becomes psychologically more difficult. This friction, this psychological hurdle to selling, is not a bug, it's a feature. It is a powerful behavioral tool that enforces the long-term discipline required for tax-efficient compounding. To cultivate this discipline, you need a mental model that forces this shift in perspective. Let's call it the business owner mindset blueprint. This is a practical exercise to perform before you buy any stock, and it will fundamentally change your relationship with your investments. Step 1. Before you invest a single dollar, you must be able to write down, in simple language, 3 durable competitive advantages of the business you are about to buy. Why will this company be successful for the next decade? Is it a powerful brand, a network effect, a low-cost production process? If you cannot articulate this, you are not investing. You are speculating. Step 2. You must explicitly define the very limited conditions under which you would sell. Think about it as if you were the sole owner of a local private business, like a successful restaurant. What would make you sell it? Perhaps the city builds a new highway that diverts all traffic away from your location, permanently impairing your business. Or maybe someone comes along and offers you a price so outrageously high that you would be a fool to refuse. These are the types of conditions you must set for your stocks. You would not sell your restaurant because of a bad jobs report or a rumor about interest rates. You would only sell if the long-term fundamentals of the business itself were broken, or if you were presented with an extraordinary opportunity. Step 3. Create a do-nothing journal. Every time you feel the urge to sell a core holding because of market noise, fear, or greed, you must open this journal. Write down the date, the stock, the current price, and the reason your emotions are telling you to sell. Then, write a paragraph reaffirming your original business owner thesis from step 1. Then, close the journal and do nothing. 6 months later, revisit that entry. More often than not, you will find that the storm has passed and that your decision to remain inactive was the correct and most profitable one. This model systematically rewires your brain to favor long-term ownership over short-term trading. The antithesis to this approach is what we can call the cult of action. This is the entire ecosystem of modern finance, a system that is fundamentally structurally opposed to a buy-and-hold strategy. Think about it. Every single player in the financial industry, except for you, benefits from your activity. Your broker makes money when you trade. Actively managed mutual funds justify their high fees by constantly changing their holdings. The financial news networks need volatility and action to generate ratings and advertising revenue. Their entire existence is predicated on convincing you that you must do something right now. They scream headlines like, "The top 5 AI stocks to buy now," or "Warning, sell these 3 stocks before they crash." This creates an immense psychological pressure on the individual investor. To sit still and do nothing while the world screams at you to act feels like you are being irresponsible. This cult of action also manifests in the common advice to rebalance your portfolio frequently. The idea is to trim your winners that have grown to be a large percentage of your portfolio and add to your losers. While strategic, infrequent rebalancing can be a valid risk management tool, an obsessive focus on maintaining precise allocation percentages, say 5% in every stock, can become a tax-generating nightmare. It forces you to constantly sell your best-performing assets, your greatest business successes, purely for the sake of cosmetic neatness in your portfolio. It punishes excellence and interrupts your best compounders, all while triggering unnecessary tax bills and paying back your valuable personal float. The direct financial connection of this principle is measured by a simple but critical metric: portfolio turnover rate. This is the percentage of your portfolio that is sold or replaced in a given year. A turnover rate of 100% means that on average, you replace your entire portfolio every year. Many actively managed funds have turnover rates well in excess of 100%. This is a direct indicator of a tax-inefficient strategy. In stark contrast, Warren Buffett's portfolio strategy at Berkshire Hathaway results in an exceptionally low turnover rate, often in the single digits. This isn't an accident. It is the direct, mathematical consequence of his do-nothing philosophy. A low turnover rate has 2 massive financial benefits. First, it dramatically reduces transaction costs. While commissions may be 0 on many platforms, there are still hidden costs, like the bid-ask spread, that eat away at returns with every trade. Second, and far more importantly, it is the mechanism that preserves the tax-deferred compounding of your personal float. A low turnover rate is the tangible evidence that you are letting your winners run, allowing your capital and the government's capital to work for you, uninterrupted, for the longest possible time. When you are evaluating a potential financial advisor or a mutual fund, don't just ask about their performance, ask about their turnover rate. It will tell you more about their true after-tax long-term value to you than almost any other number. A commitment to low turnover is a commitment to maximizing your final, spendable wealth. This naturally leads to the 4th pillar, which is the foundational requirement for a successful long-term low turnover strategy. You cannot simply buy any stock and hold it forever. The hold part of the equation is only powerful if you first master the buy part. This is the quality filter, the absolute necessity of buying businesses you never want to sell. A low-turnover strategy with a portfolio of mediocre companies is a recipe for disaster. A low-turnover strategy with a portfolio of truly wonderful businesses is the formula for unimaginable wealth. The story that best marks Buffett's own evolution in this thinking is the acquisition of See's Candies in 1972. At this point in his career, Buffett was still very much a cigar butt investor, a student of Benjamin Graham, looking for statistically cheap companies, often of low quality. See's Candies was different. It was a beloved family-owned chocolate company with a powerful brand on the West Coast. The asking price was $30 million, but Buffett's statistical analysis told him it was only worth about $25 million based on its tangible assets. He was ready to walk away. It was his partner, Charlie Munger, who pushed him. Munger argued that they should be willing to pay a premium price for a premium business. See's wasn't just a collection of assets. It was a brand that lived in the minds of its customers. It had immense pricing power. They could raise the price of their chocolates every year without losing customers, because people weren't just buying chocolate, they were buying nostalgia, tradition, and quality. It required very little new capital to grow. They bought it for $25 million after some negotiation. That purchase fundamentally changed Buffett. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire over the years, requiring very little additional investment. It was a compounding machine. It taught Buffett the most important lesson of his career. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Because wonderful companies are the kinds of businesses you can hold for decades, allowing the magic of tax-deferred compounding to run its full course. The psychological shift required here is to develop what we might call a quality bias, which is the antidote to the common value trap bias. Many investors are mechanically drawn to stocks with low price-to-earnings or price-to-book ratios. They see a low number, and their brain registers, quote, cheap. But often, these stocks are cheap for a very good reason. They are in dying industries, they have incompetent management, or they have no competitive advantage. These are value traps. The stock price is low, but the underlying business value is deteriorating even faster. To become a quality-focused investor, you have to train your brain to look beyond the simple statistics and analyze the intangible, qualitative aspects of a business. You have to think like a business strategist. What is this company's moat? That is Buffett's term for its durable competitive advantage. Is it a powerful brand like Coca-Cola that creates customer loyalty? Is it a network effect like Visa or MasterCard, where every new user makes the service more valuable for all other users? Is it a low-cost advantage like Costco that allows it to consistently undersell competitors? Focusing on the quality and durability of the moat forces you to think in terms of decades, not quarters. It moves your focus from the fluctuating stock price to the underlying long-term earning power of the business, which is the only thing that matters for a true long-term investor. The mental model for applying this quality filter is the 10-year test. Before you purchase a single share of stock, you must put it through this rigorous qualitative interrogation. Imagine you are buying the entire company with your family's entire net worth, and you are forbidden from selling it for at least 10 years. This hypothetical constraint forces a radical shift in your decision-making process. Step 1. Can you describe, in a simple paragraph that a 10-year-old could understand, exactly how this business makes money and why it will almost certainly be making significantly more money a decade from now? This forces you to focus on the fundamental business model and its long-term growth trajectory, ignoring short-term market sentiment. Step 2. Identify the single biggest threat to this business over the next 10 years. Will it be technological disruption? A change in consumer behavior? New competition? Then, you must articulate the strength of its moat that will defend it against this threat. How will Apple defend against a new smartphone competitor? How will Google defend against a new search engine? If the defenses seem weak, you must pass on the investment. Step 3. Ask the ultimate question. Would you be perfectly happy to own this business if the stock market were to close tomorrow and not reopen for 10 years? This is the killer test. It completely removes the stock price from the equation. If your answer is yes, it means you have true conviction in the underlying business. If your answer is no, it means you are likely gambling on the stock price, hoping a greater fool will buy it from you at a higher price later. Passing the 10-year test is the prerequisite for entry into a portfolio designed for masterful inactivity and tax-deferred compounding. The antithesis of this quality-focused approach is Buffett's own original strategy, the cigar butt method. He learned this from his mentor, Benjamin Graham. The idea was to find a company that was so beaten down and so cheap that it was like finding a discarded cigar on the street with one last free puff left in it. You could buy the stock for less than its liquidation value, sell it when the price recovered slightly for a small, quick profit, and then move on to find the next cigar butt. The original Berkshire Hathaway, the failing New England textile mill that Buffett bought in the 1960s, was a classic cigar butt. It was a terrible business in a dying industry, but it was statistically cheap. Buffett quickly learned that this was a horrible way to build wealth. First, it required constant activity. You were always on a treadmill, having to find new, miserable companies to buy. Second, your capital was always tied up in terrible businesses. As he famously said, when a manager with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. The cigar butt approach is fundamentally incompatible with the long-term tax deferral strategy. You would never want to hold a dying textile mill for 30 years. The business itself would evaporate. The shift from buying cigar butts to buying wonderful businesses like See's Candies was the critical pivot that unlocked the power of long-term holding and, by extension, the power of the tax float. It was the realization that your stock selection strategy and your tax strategy are not separate. They are two sides of the same coin. The financial connection here is one of the most important metrics in all of investing. Return on invested capital, or ROIC. ROIC measures how efficiently a company is using its capital to generate profits. A company with a consistently high ROIC is a true compounding machine. Think of it this way. A great business, like See's Candies, generates a lot of cash. It can then take that cash and reinvest it back into the business, opening new stores, improving its website, at a very high rate of return. A company with a 20% ROIC is effectively reinvesting its profits and earning 20% on them. As a shareholder, you benefit from this internal compounding without having to do anything. Your capital is being put to work at a high rate of return within the company itself. This is the engine that drives long-term value creation. When you buy a company with a high and durable ROIC, you are essentially outsourcing the job of compounding to a talented management team running a fantastic business. This internal compounding is completely tax-free. The company's profits are growing inside the corporate structure before they are ever paid out to you as a dividend or reflected in the stock price. By identifying and holding these high ROIC businesses, you are harnessing a double compounding effect: the internal compounding of the business's profits and the external, tax-deferred compounding of your investment in your brokerage account. This is the ultimate financial one-two punch for supercharged portfolio growth. We now arrive at the final and perhaps most powerful pillar of this entire strategy. It's the culmination of a lifetime of disciplined, tax-efficient investing. This is the final promise: leveraging estate planning to utilize the ultimate tax loophole, what is known as the step-up in basis. This is the move that takes the chess game against taxes and declares a permanent checkmate. While Buffett himself is a unique case, his own plans for his fortune provide the perfect framework for understanding this concept. For over half a century, Buffett has held his shares of Berkshire Hathaway. His cost basis, the price he paid for his original controlling shares, is astonishingly low, effectively near zero relative to their current value. His unrealized capital gain is one of the largest in human history, well over $100 billion. If he were to sell his shares today, he would face a tax bill in the tens of billions. So what is his plan? He has pledged to give more than 99% of his wealth to philanthropy, primarily through the Bill and Melinda Gates Foundation. When he donates his shares, it is a non-taxable event for him. The foundation then receives the shares and can sell them to fund its charitable work, and as a non-profit organization, it pays no capital gains tax. But the principle that applies to everyday investors is what happens to the shares he leaves to his estate for his family. Under current U.S. tax law, when an individual passes away and leaves appreciated assets like stocks to their heirs, those heirs receive the assets with a stepped-up cost basis. This means their new cost basis is not the original price the deceased person paid, but rather the fair market value of the asset on the date of death. Let's make this concrete. Imagine our hero Tom, from the first example. After a lifetime of holding, his initial $10,000 investment has grown to $2.37 million. His cost basis is still $10,000. If he sells it the day before he dies, he owes nearly $500,000 in taxes. But if he holds it and passes away, his children inherit that stock. Their cost basis is not Tom's $10,000. Their cost basis is stepped up to the current market value of $2.37 million. They can turn around and sell the entire position the very next day, and, because their sale price is the same as their cost basis, their capital gain is zero. Their tax bill is zero. A lifetime of accumulated tax-deferred capital gains is completely legally and ethically extinguished. It vanishes. This is the final, magnificent payoff for a lifetime of patience, inactivity, and quality-focused investing. It is the ultimate expression of after-tax returns, where the effective tax rate on a lifetime of compounding becomes 0%. The psychological hurdles that prevent people from taking advantage of this are deeply human. The first is simply myopia and procrastination. Estate planning forces us to confront our own mortality, which is uncomfortable. It also seems complex, something to be dealt with later. The benefits of the step-up in basis are not for us but for our heirs, making it the ultimate act of delayed gratification. It's easy to put off. The goal of this pillar is to reframe this. Estate planning is not a morbid administrative chore. It is the final, brilliant strategic move in your wealth creation plan. It is the act of preserving the financial fortress you have spent a lifetime building. It's not about death. It's about legacy. It's about ensuring that the value you created through decades of discipline is transferred with maximum efficiency to your family, your community, or the causes you care about. It is the final victory over the invisible anchor of tax drag. To put this into practice, we need a generational wealth blueprint. This is a model for thinking about the final phase of your investment life. Step 1. Know your basis. From this day forward, you must meticulously track the cost basis of all your long-term investments. This number is as important as the current market value. Understand that the spread between these two numbers represents your massive, growing, tax-deferred personal float. Step 2. Adopt a hold-at-all-costs mentality for your core, high-quality holdings as you approach and enter retirement. The conventional wisdom is to sell stocks to fund your retirement. This blueprint suggests you fight that instinct. Instead of selling your low-basis winners, consider other strategies. Live off dividends and other income sources. If you need more capital, consider borrowing against your portfolio, a strategy many high-net-worth individuals use. A portfolio-backed loan allows you to access cash without selling assets and triggering a tax event. The goal is to get as many of your highly appreciated low-cost basis shares to the finish line of your death as possible. Step 3. Formalize your plan. Work with a financial advisor and an estate planning attorney to ensure your assets are titled correctly and your will or trust is structured to allow for a smooth transfer to your heirs. This is not a do-it-yourself project. Professional guidance is crucial to ensure you navigate the legal complexities correctly. By following this blueprint, you are no longer just managing a portfolio. You are curating a legacy. You are ensuring your life's work of compounding is not decimated by a final, massive tax bill. The antithesis of this is the tragically common path of the retirement liquidator. This is the person who follows the standard financial advice to the letter. They spend 40 years diligently saving and investing, building a beautiful portfolio of winning stocks. The day they retire, they flip a switch. They go from being an accumulator of assets to a systematic liquidator of assets. To generate income, they start selling off chunks of their portfolio every year. And what do they sell first? Often, their biggest winners, because that's where the most cash is. Each sale is a taxable event. Each sale is a repayment of a piece of their precious personal float. They are taking their perfectly built compounding machine and slowly, methodically disassembling it, giving a significant portion of it to the government along the way. It is a slow, tax-inefficient bleed-out. They spend the last phase of their financial lives undoing the very thing that made them successful in the first place: the uninterrupted, tax-deferred compounding of capital in wonderful businesses. They are forced to do this because they never considered the alternative, the generational wealth blueprint, which allows them to preserve the machine while still accessing the capital they need. The ultimate financial connection is the most dramatic of all. It is the difference between a legacy diminished and a legacy maximized. Let's return to that final, powerful example. An investment of $10,000 grows to $1 million over a lifetime. The cost basis remains $10,000, meaning there is a $990,000 unrealized capital gain. If that investor liquidates this asset to fund their retirement or simply to put it in a safer investment, they will immediately face a federal capital gains tax bill of nearly $200,000, plus state taxes. Their $1 million asset instantly becomes an $800,000 asset. By following the generational wealth blueprint and passing that asset to an heir, the $200,000 tax liability is legally eliminated. That is a direct, quantifiable transfer of $200,000 of additional wealth. It is the prize for understanding the entire system, for playing the game not just for 1 year or 1 decade, but for a lifetime and beyond. This is the final secret. It's the understanding that the single most powerful tax management tool is time. By extending your time horizon not just to your own retirement but to the next generation, you unlock a level of tax efficiency that transforms a great investment outcome into a truly monumental one. This is the final promise of Warren Buffett's way, a strategy that is not just about getting rich, but about creating lasting, generational wealth. You have just spent this time fundamentally rewiring your financial brain. You no longer see taxes as just a bill to be paid at the end of the year. You now see them for what they are: an invisible anchor on your portfolio, a relentless drag on your journey to wealth. But more importantly, you now possess the blueprint to transform that anchor into a powerful tailwind, an interest-free loan from the government that supercharges your compounding. You have learned to see inactivity not as laziness but as a strategic weapon, and to view your stocks not as trading chips but as pieces of businesses you intend to own for the long haul. But mastering tax efficiency, as critical as it is only one pillar in the grand architecture of wealth. Buffett didn't just hold stocks, he held the right stocks. He didn't just buy them, he bought them at the right time. The principle you've learned today is the powerful, high-performance engine of the car. But what about the chassis that provides its strength, or the steering wheel that guides its direction? How does this tax strategy of infinite patience connect with the art of intelligent valuation and the brutal psychology of market cycles? How do you know when to buy the wonderful businesses you intend to hold forever? The video you see on your screen right now is not just another random recommendation from an algorithm. It is the next piece of the map. It is the crucial link that connects the how of tax deferral, which you have just mastered, with the what and the when of intelligent capital allocation. It is the bridge between the virtue of patience and the necessity of decisive action. Many people will stop here, content with this one powerful secret. They will feel they've learned enough, but those who are truly serious about achieving financial freedom, about building a fortress of capital that can withstand any storm, Understand that each principle is a gear in a larger interconnected machine. The choice, as always, is yours. Are you merely a collector of interesting ideas? Or are you an architect of your own financial destiny? If you are the latter, then you already know what to do. Continue the ascent. Click the video and install the next piece of your mental arsenal.